Okay, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be walking you through how we are viewing the current market. But before we get started, the usual quick disclaimer. The types of security forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we'll be starting off with the major indices as usual, highlighting some key levels, and especially after last week's price action, definitely a case for more optimism. So always good to know where the next support and resistance levels are here for the major indices. From there, we'll be moving on to fixed income, commodities, and crypto. On the fixed income side, yields have pulled back, but are starting to consolidate at current levels. So we are starting to see that initial momentum in bonds or that initial rebound in bonds fade away. In terms of commodities, oil has recently broken out of its monthly resistance level. So that is quite significant for oil. And taking a look at Bitcoin has also rebounded off a major support level after multiple weeks of just simply consolidating and losing a lot of momentum. We'll take a quick look at the sector rotational model, see what sectors are outperforming and underperforming the overall market. We'll take a look at two subsectors of interest for you that I have today, and we'll end today's session with some bullish and some bearish market observations. So starting off here with the S&P 500, and last week was a very encouraging week for the S&P. Despite this overall significant downward trend, we saw 380 act as a strong support level. 2 weeks Friday, we saw a very strong bounce from that level. And since then, price has found some momentum to actually break above this 404 resistance level that I highlighted last week, and is already within this range between 404 and 428. Now, it is encouraging to see a break above its 21-day exponential moving average as well. And, looking at the charts itself, being in between this range, it means that 404 would be the next support level and 428 would be the next resistance level that has acted as support in the past and more recently has also acted as resistance. That being said, it still has its 55-day exponential moving average near the 420 level to surpass. And also futures are trading a little bit lower this morning over fears again of, the Fed possibly looking to, or some speakers of the Fed are possibly looking to accelerate these Fed hikes. That being said, for the first time in a long time, first time this year, I'd say, I am a lot more optimistic about the recent rebound because we have finally seen a strong enough fundamental catalyst to warrant this rebound, right? We spoke a lot about these relief rallies throughout the year. There was a relief rally there, there was a relief rally there, another relief rally there. I wouldn't call this one a relief rally. That was more Fed induced. But, with all these relief rallies, there wasn't really a fundamental catalyst. It simply came down to quote unquote bargain hunting. But now, this is actually the Fed finally for the first time this year stating some good news last week. They mentioned that they aren't looking to accelerate the rate hikes. And that's what markets were fearing. And that's what, investors were preparing for, which is why we saw such a strong decline. And, for that reason, I do think this 380 support level is a strong support level, and I do think it'll hold. Now, I'm not saying we're going to see this very strong rebound all the way back to 453 or even all-time highs at 480. It's just not the right environment or macro environment for that. But from an area of support, I do think that, we now have a good fundamental catalyst to say that 380 should hold as probably a strong area of support and possibly act as a base. So even if price comes back to retest that, I do think 380 will be a very strong level. And that's also at the 38.2 Fib retracement level. That being said, there is still recession fears, and that will be the key headwind for equities and may limit some upside. But, a relief rally from oversold levels is what's been happening. if you look on the weekly chart, the 200-day, the 50 period CCI, which measures longer term momentum, that did approach this oversold condition at minus 200 and stayed there for 2 weeks and is now finally rebounding. So again, it does point to a rebound, and the fact that there's a fundamental catalyst for that, it does lead me to believe it's more encouraging, let's put it that way. And the initial target that I have, despite this slightly lower open this morning, I still think 428, 429 is definitely on the cards. Taking a look at the NASDAQ 100. So the cues, they very similar in terms of price action to the S&P, broke above its 21-day exponential moving average on Friday. And last time I checked, futures are still fairly flat. So I do think there's still more room to the upside. Next key area would be between 320 and 316, and that would be near its 55-day exponential moving average. And should a break above this area, it's back within this range between 320 and 340, which is probably the best case scenario for the NASDAQ 100, which is so heavily reliant on growth names and has suffered over this year due to rotation out of growth. That being said, I wouldn't be surprised to see a short-term retracement. If we take a look at the 6-period CCI, which is a red line, it is approaching that overbought reading. And, normally at this level, we tend to see a slowdown in momentum. So that might indicate a small retracement to retest 300 before that move higher. Moving on to small caps. So IWM, the Russell 2000 ETF, definitely looking more promising. For the first time in a while, it is starting to outperform the larger cap names and showing signs of further outperformance. We'll take a look at that in the next chart. But for now, we are seeing price retest that key 188 level. Now, this morning, it is set to open a little bit lower. Let's see how it behaves over the next couple of days. The next couple of days are going to be vital. Will we get a break above 188? Because if we do, it's back within this range, right? It's back within the 188 210 range. If we take a look at the fib levels, which it has been respecting, a break above 188, the 38.2 fib retracement level is quite significant, as it would open the door for a retest of 210. But more importantly, it means that small caps could remain in this range. That being said, if we see a failure to break above 188, we could be seeing a revisit of this 170 level, 50% fib retracement, and the pre-pandemic area as well. So it's a very key area at 170. But let's see how small caps perform over the next few days. So large caps versus small caps, pretty interesting in my opinion, a pretty interesting ratio chart. So this is a ratio chart that compares the S&P 500 against the Russell 2000. And when it moves higher, it means that large caps with the S&P are outperforming the small cap names in the Russell 2000. And we have seen, since 2021, this more longer term outperformance for the S&P relative to small caps. We saw also in 2021, there was a very long period of consolidation for IWM. That being said, we're looking at the momentum on a daily time frame. That is definitely slowing down. We are seeing signs of this topping formation, and especially in recent weeks, there is a support area here at a 2.2, and if this can break to the downside on a relative basis, that does open the door, and that does indicate further downside for this chart, which would indicate further outperformance for small caps relative to large caps. And, the other thing that I would point out is when small caps outperform large caps, that's usually the sign of an early bull market. I don't necessarily think that's the case for this time, considering, recession fears, Fed rate hikes are still definitely in play, and of course, inflation. But it is still a good sign, nonetheless, at least in the short term, to see small caps finding some ground relative to large caps. Moving on to the VIX, and VIX was looking good last week, right? We saw multiple days of it rejecting the 30 area, the key 30 area, and moving lower, breaking below its 21 and 55-day exponential moving averages. But what is still concerning is the fact that it's still elevated. I would have liked to see a further downside here for the VIX, possibly back to maybe even that trend line near 22, even 23, but that's just not happening. It seems like even if the VIX isn't breaking above 30, it's still not necessarily breaking down all the way to the 22, 21 area, which would make trading conditions a lot easier, which would support the thesis for an extended recovery, a relief rally. And, even this morning, VIX moving higher back above its 55-day exponential moving average. So this is probably the one, you can call it an indicator, but the one indication that says that maybe, this maybe isn't a relief rally. It's too soon to say because VIX is still elevated. It's not breaking below 26. That's still an elevated level. There's still a lot of correlation. There's still still a sense of risk-off sentiment. And, I do encourage you to be careful. I do encourage you to take a look at the VIX more often. You'd want to see a further move lower. It's normal to see when the VIX is at elevated levels and a move lower, even a small move lower, a systemic rise in equities. It doesn't necessarily mean that rise is there to stay. It doesn't necessarily mean that it's going to be a long-lived rally. It just means that, there's a volatility crush and less systemic risk, at least in the short term. But when the VIX doesn't move lower with that much momentum, that is concerning for me. And the fact that it's opening higher this week already, it's not something that, it's one thing I'll be looking out for. Okay, taking a look at value versus growth. And, the first thing I'll say is that this chart is definitely overbought. Take a look at the weekly time frame. 50-period CCI is above 200, which is an overbought condition. So this does point to a relief rally because, again, this is a ratio chart, right? So, and measures value against growth, the relative performance of value against growth. So the higher it moves, it tells us that value is outperforming growth, and the lower it moves, it tells us that growth is outperforming value. And in relief rallies, growth does tend to outperform value. But with value, having such a strong outperformance relative to growth in the last few months, and approaching this overbought territory, it does lead me to believe that we should be in store for a rebound here in growth relative to value and a relief rally in the major indices. That being said, one of the predominant themes for 2022 is still rotation into value and out of growth. And I don't think just because that this chart is overbought that it cancels the underlying macro fundamental thesis of that rotation. So I will say for the medium to longer term, I don't necessarily think this points to a longer term growth rally relative to value. But for the shorter term, yes, it does point to a relief rally at the very least. There's plenty of room to the downside here for this chart. Moving on to the US 10-year yield, and pretty interesting. So we highlighted this last week, and 320 basis points was really that major resistance area, immediate rejection from there, and yields have calmed down, especially with the Fed, or especially from last week with the Fed stating that they aren't going to be aggressively or as aggressive as originally anticipated in terms of rate hikes. And we are starting to see yields balance out at around the 270 basis point area that we pointed out last week. So finding support there, but also overall a lack of upside momentum. Let's see what happens over the next few days. The higher yields move, the more of a headwind it is for equities, but also it makes no fundamental or macro sense for yields to break down much lower. I'd be very surprised that even if this 270 basis point level broke, for yields to break below 250 basis points, the macro environment still points to yields remaining elevated. And moving on to bonds. So when yields move higher, bonds tend to move lower and vice versa. And with TLT is a name we've covered now for a number of weeks, and I have on multiple occasions highlighted this 122 area. That was my short-term rebound target for a bearish opportunity because I'm still overall bearish on bonds. No surprise there considering just how much of a bearish trend we've experienced this year. But in terms of a better risk-reward opportunity, I was hoping for a rally back to that 122 area, which is a major area of resistance, especially on the weekly time frame. And so far, that just does not seem to be happening. We can see that price is running into resistance at around 119, 120. And, overall lack of upside momentum, especially in the last few days. Even though it's above its 21-day exponential moving average, it does look set to open lower, especially with bonds starting to settle off. So overall, I do think there's probably potential. There's potential for for bonds to revisit this 112 area, which was a previous swing low. Taking a look at gold, and gold was showing promising price action for a rally back to 177 last week. We saw a break of structure here, a break of this topping formation, and price broke below support at 177, came back to retest it on multiple occasions, failed. It reached our older target of 171 and declined all the way to 168 before finding support and managing to break back above this 171 resistance level. Retested it on multiple occasions. And just last week, we're not seeing that momentum you want to see, because even though you saw a clear break and what was looking like a nice retest, you'd normally be waiting for that move, that capitulation higher all the way to 177 on the 171 level. And so far that doesn't seem to be happening. I do think 171 is still a solid support level, especially with the dollar running into some recent weakness. It is still elevated, no doubt, but if the dollar continues to weaken, that would be the catalyst for gold to rally. And the next key area would be 176, 177. So that would be the area to look out for. And in terms of an optionable trade idea, I would probably shift towards more of a credit spread strategy. It's more neutral, more forgiving, and less of a break even compared to a debit spread. So I'll be looking for that credit spread with 171 as a key area, and a break below that would invalidate that analysis. And sorry, I'm not sure why this slide I meant to delete. Crude. Sorry, I actually have the wrong slide here. Let me get crude up. Apologies for that. But taking a look at oil. So oil, we saw this very long consolidation period, and finally price managed to break above this major 116 resistance area yesterday. And there's a lot of momentum behind this move. This comes off the back of basically the EU banning 90% or going to ban 90% of Russian oil. So it was a move that was starting to get priced in the last few days, but a breakout there does indicate, continued upside. There is going to be a supply and demand imbalance, definitely. So it's no surprise to see oil starting to rally and break out. So over the next few days, I wouldn't be surprised to see a revisit to the 128 area. Okay. So moving on to Bitcoin. Bitcoin is somehow managing to survive at current levels. We can see here this is a Fibonacci retracement drawing from pandemic lows all the way to all-time highs at around 70,000. And, the 61.8 is probably one of the most important Fibonacci levels to be made aware of. It tends to, that time and time again, price tends to pull back to that area and bounce more often than the other areas. And especially in the case of Bitcoin, on a weekly level, we can see how strong this area has acted as support. Every time prices pull back to this area, there's always been a very strong reaction to the upside. And over the last month or so, we haven't really seen a strong reaction. We did see initially a break below that level, very quickly recovered. But price, was almost consolidating and almost looked like it was going to spill over back down for a revisit of 26,000. But over the last couple of days, sentiment has definitely shifted to more of a risk-on sentiment. And we are seeing that strong rebound here for Bitcoin. That being said, I'm not sure how long this would last. We would need to break above 32K for me to see price really start to at least have a short-term rally. But I don't believe there's a strong enough fundamental catalyst for it to really have have a strong rebound from current levels. So my sentiment here is still quite neutral for Bitcoin. So moving on to sector rotation. We currently have 8 sectors in the improving and leading category. We have 3 sectors in the lagging and weakening category. So taking a look at the leading category, first, we have energy. There was showing a severe loss of momentum over the last few weeks. That has since recovered off the back of elevated oil prices. I expect this to actually gain relative momentum against the overall market and continue higher. By far the best performing sector in 2022. But take a look at the other sectors within this category. We have staples, we have utilities. These are defensive names, and when we experience a relief rally, we tend to see some rotation out of these sectors. So I do expect to see maybe relative underperformance in staples and utilities if this relief rally continues. That being said, I don't think it's a strong enough reason to lose exposure within these defensive sectors when you consider the fact that the macro fundamental outlook for the medium to long term is still quite bleak. So staples and utilities remaining in the leading category. We are seeing real estate lose a lot of momentum. And you have to remember that with recession fears as high as they are, the housing market is one of the first to go, right? So no surprise to see real estate losing that momentum. It is still in the leading category, but I fully expect this to rotate into weakening very soon. Taking a look at the lagging category, though, technology and financials are finally showing signs of life. Improving momentum. I would like to see it improve to rotate into the improving category for a more solid change in sentiment. But it's still, especially financials, a name that sold off quite significantly despite higher yields, which normally would perform well against. It's good to see financials start to show recovery, and I do have a couple of financial names to go over for today's session. But taking a look at the first sector of interest, and it's real estate. Price action for real estate has been a little bit tricky in the last couple of days. Originally, I saw a break below this 44 support level, a rebound, and some nice bearish price action at the 44 area. On Thursday, it was the only red sector in the S&P 500. So that does speak to, its loss of relative performance against the overall market. But Friday, we saw a very bullish day for all equities, and that did see price break above that 44 level. So it would invalidate that. If I had placed a trade there, it probably would have invalidated that trade right away. But from a fundamental and macro perspective, I'm still bearish on real estate. And, fine, even if it broke above this resistance level, how much more room is there to the upside? It has this 55-day exponential moving average to compete. And there was some resistance as well at around 46. So I do think, there's some evidence that points to the continued rally for the real estate sector. But again, you have to think about it on a relative basis. How is it going to perform against the other sectors? And again, fundamentally, real estate is going to be quite weak with all these recession fears. So I'd be looking for bearish opportunities for real estate. We might have to be a bit more patient. We might have to let price rally a little bit higher, possibly to even 47 before we see those bearish opportunities. But this will definitely be one for the bearish watch list. And taking a look at technology. Technology, again, has come back to life. We saw this strong bearish trend, multiple support levels broken, even this support level at 140. At 140. That was broken a couple weeks ago. Price found support at 128 and is now moving higher with a lot of momentum. So we did see price break back above 140, above its 21-day exponential moving average. And it's good to see, short-term and longer-term momentum drastically improving. Next area of resistance is at around 148. So 148, that'll be the key area to look at for potentially bearish price action, right? And we know that we are experiencing a relief rally. We don't know how long it's going to last. But if it is an extended rally, I wouldn't be surprised to see a break above 148, just considering how far technology has really sold off. And if it breaks above 148, we're back in this range, the 160, 148 range. But again, let's see what happens. Let's see how price behaves at 148 should it reach there. Moving on to some subsectors of interest. The first one I have for you is IBB, which is a biotechnology ETF. And this is an interesting chart because we have very clear support and resistance levels. And on the daily time frame, we can see multiple areas of support being broken. It's clearly respecting its resistance levels. And more recently, there was a break below that 120 area, found support at around 105, 106. Actually managed to break above its 21-day exponential moving average last week. But this is an area of major resistance. You can see here on the weekly time frame, that has provided resistance in the past. So I'll be looking very carefully at how price behaves in this area over the next few days, whether it starts to show some bearish price action, and that would indicate a very good risk to reward bearish entry point for a move lower back to its previous swing low at around 105. And if that level breaks, take a look at the weekly time frame. The next major weekly support level is all the way at around 100. Moving on to KRE, which is a regional banking ETF. And this is more about the weekly time frame, to be honest with you. So we have the support level at $60, which kind of matches the pre-pandemic drop level. And it has acted as a pretty strong support level, right? We see a couple of times our prices approach this area and has found support and has bounced higher. On the daily time frame, there was some consolidation for a couple of weeks before we saw the bounce higher, but price managed to break back above its 21-day exponential moving average, and there's a lot of momentum behind this move. So again, going back to the weekly time frame, though, we see a nice bullish candle at an area of major support. That's what you want to see heading into a new week, and it would indicate, a continued rally this week could be on the cards. I'd be looking at around the 68 area, 67, 68 area as a potential target. Would have to break above its 55-day exponential moving average to do that. But that area has acted as support in the past. So that'll definitely be the next key area to look at. And moving on to some bullish market observations. Another financial name, JP Morgan. So JP Morgan, long-term bearish trend, but it is starting to break that bearish structure. Price broke above its 21 and 55-day exponential moving averages very recently. A lot of upside momentum, especially with longer-term momentum turning positive. That's very encouraging. And even if we start to see some consolidation, what would be more encouraging is if price can maintain above 127, because that would indicate, we could be in store for another bullish leg. And the next key area of resistance that I'd be looking at is 140, which was a pre-pandemic drop level and a strong area of resistance in the past, as you can see. So it is quite interesting to see JP Morgan actually trading below its pre-pandemic drop level. Not many names, are doing that, and especially after that massive rally that we've seen over the last couple of years. So I do think there's a good opportunity here, a good bullish case here for JP Morgan, and a revisit of 140 is definitely on the cards. Taking a look at NVIDIA. So NVIDIA sprang to life from its earnings announcement. We saw this support area break at 210, and that was a very key support level. I was actually quite bullish on NVIDIA at this 210 level. That eventually broke and invalidated my analysis, but price did find some support at 160. And from a fundamental perspective, NVIDIA is very strong. That and AMD, among a handful of semiconductor names, they are the best in class of semiconductors. So I do think there's a very good fundamental case for NVIDIA, but obviously macro risks and systemic risks are always going to be there to drag price lower. That being said, recent price action is quite promising. And I think with the momentum it has, and with, if we could see a continued relief rally, some momentum from last week, I do think NVIDIA could rally back to the 200 area, run into some intraday resistance, but 210 would be the key area that I would be looking at for NVIDIA. Okay, another bullish market observation is Goldman. So Goldman, again, another financial name, and we are starting to see it break structure. We have the support line or support area just near where price is. So price is now retesting this area, but it did break above its 21 and 55-day exponential moving averages. Good momentum turning positive. So I'd like to see, continued rally to possibly that 345 area in the short term. Again, if this momentum can keep going. Moving on to Pfizer. So Pfizer, part of the healthcare sector, which is traditionally a defensive sector, but we are seeing some rotation out of that sector. And the daily chart is at a key area. You can see the price has run into resistance near the 55 area on multiple occasions. So what I'll be looking for is bearish price action, which we did see on Thursday and even Friday. Not a lot of upside momentum, despite the strong rally in equities across the board, set to open lower this morning. And from a risk-reward perspective, excellent bearish entry point. I'll probably say it's a very short-term trade. You don't want to bet against healthcare or defense sector for the long term, given the current environment. But potential target price could be all the way back down at around $50. And finally, we have Comcast, part of the communications sector. And communications has just, has struggled to find momentum recently. And overall, a lot of names in that sector are quite bearish. We are seeing a strong bearish trend. And more recently, a very strong move lower, price found support at 40, and managed to rally, breaking above its 21-day exponential moving average, losing a bit of steam near its 55-day exponential moving average, which is in line roughly with that 45 area, which has acted as support in the past. There might be a little bit more upside, but this is definitely a name that I'll be looking for potential bearish opportunity in the next few days. I'd like to see some bearish price action near that 45 area. And again, good risk to reward, bearish entry point for a revisit back down all the way to around 40. Okay, and with that is all I have for you today. Thank you so much for joining me. I know we went a little bit above schedule, but I hope you enjoyed the session, and I hope that you learned something. I hope you have a great trading week ahead, and I will see you next week. Goodbye.